Hello, good morning, and thank you so much for joining us today at the latest instalment of the BetaShares Quarterly Economic Update webinar. This is arguably one of our most popular sessions throughout the year, and David Bassanese talks to the most recent RBA announcement, and the session is entitled COVID-19 is the worst over. Before we get started, I'd just like to remind you that information contained in this session today is general in nature only. Fund product disclosure statements are available on our website, and any reference to past performance is not indicative of future performance. We do recommend you obtain financial advice before you make any decisions. Throughout the session, if you do have any questions, we encourage you to ask them by selecting the question call out widget on the right hand side of your screen. We will try and get to as many questions as possible. We've already had a few come through, so thank you very much. David will be answering questions at the end of the session, so if there's anything that you would like to ask, please do so throughout. The BetaShares website is a great source of information, education, and fund data. Please visit the site for all the information on our funds. You can also sign up for our regular insights. David sends out a Bassanese Bites, which is a Monday morning snapshot of the week ahead and some highlights from an economic standpoint. You can also follow us on all the socials if you'd like to be kept up to date. Just a little bit about BetaShares. We founded in 2009. We are proudly one of Australia's leading ETF providers. 64 of our funds are available on the ASX, and we have just over 12 billion in funds under management. Our three most recent funds are currency hedged versions of three popular ETFs. We have our Global Quality Leaders, our Global Sustainability Leaders, and also our NASDAQ 100 ETF. So these are now all available in currency hedged versions. I'd like to introduce our speaker this afternoon. Hopefully you're familiar with David Bassanese. He's chair of the investment committee at BetaShares and responsible for developing economic insight and portfolio construction strategies. He was also a columnist at the AFR and is author of Australia's most comprehensive ETF guide. Now, before I do hand over to David, we have a couple of poll questions that we would love your input on, just to check the mood in the room, so to speak. And the first poll question that we'd like to ask is about the RBA interest rates. So do you think, or will the RBA cut interest rates again? Quick yes or no. There was talk of a potential cut last time round, but there was no movement there. So, right, just close that off. The second poll, before we do share, is who do you think will win the US presidential election? Joe Biden, Donald Trump, or Joe Jorgensen? Howie Hawkins or someone else? I don't know if Kanye West is on the ticket yet officially, but it just seems to be between the two. Wow, okay, great. So let's just jump back quickly to the RBA decision. And it's really clear cut. I think everyone feels that the RBA won't be cutting rates again. A lovely 80-20 split there. And jumping to the US presidential election winner, Donald Trump by a nose. So I think Dave was really interested in those questions. So without further ado, I will hand over to my colleague, David Bassanese, to take you through the latest quarterly economic update. Over to you, Dave.
Thanks very much, Sarah, and good to be with you all today. And yeah, very interesting questions there. I will say a little bit about the RBA a bit later, and also on the US election. Yeah, very interesting responses there. And just in terms of the agenda today, just an update really on the COVID crisis, how we're going with respect to the this disease globally. What's been happening in terms of the Australian and global economies and the outlook in terms of economic growth. Touch on the market performance as of late, and then some investment themes. You know, following on from all of that, what are some investment ideas? Obviously, using exchange-traded funds, both from a defensive point of view and from a more, you know, growth aggressive point of view. So, firstly, just in terms of the COVID situation, as you can see, look, and these numbers obviously change on a daily basis. But when this presentation was put together late last week, we were at 19 million infected in terms of official reports. Obviously, some suggest there's a lot more than 19 million that have been infected, but it's now just over 20, I think, based on the latest numbers, and about 700,000 globally that have been affected. So in terms of official reports, it's clearly the worst pandemic still since the Spanish flu, really, since 1980, worse than the Asian, Hong Kong and swine flu. At this stage, obviously not as bad as the Spanish flu, which, you know, did infect around about 1/3 of the global population, according to the estimates at the time, with a death rate of as high as 5%. And if you actually, another way of looking at it, this is the global daily case count. And as you can see, there was some optimism in March, April, when we did have that escalation, and then things seemed to taper off. Asia got on top of the virus. Europe, the worst affected countries such as Italy, got on top of it. But as you can see, since May, June, it's continued to rise, and really it's been spreading in emerging markets, Russia, India, Indonesia, Brazil, and also in the United States. I'm sure as you've read in the papers and on TV, it was initially in New York and California. They got on top of it, and then it spread to some of the southern states such as Florida, Texas, Arkansas, and it's still running at relatively high levels in the US. But there is a variant to that in terms of how economies are dealing with it. But that's the situation. Still, in terms of daily case count around the world, still not under control, still not contained in that sense. And in fact, as we speak, you're seeing a bit of a rebound in some of the cases in Europe at the moment. France, to some extent Germany, certainly Spain, and so, you know, certainly far from contained at this stage or solved as a problem. So we're still dealing with this, still lingering around the place. And just as this chart really just highlights the different performances around the world. So if you look at it, Western Europe in yellow did get on top, which basically the story so far has been most of Asia and Europe, Western Europe, has dealt with their first wave, and there's no signs yet of a strong second wave, though a little bit questionable about Western Europe at this stage. That could be coming back. And in, say, in the US, the second wave in the US has been far worse than the first wave, in the sense of the rate of infections in the southern states is a lot higher than we saw even in New York. But the other story has been the broadening out of the virus to the emerging markets. And second wave outbreaks, you know, are sad but true in Australia. I'm sure as you know, particularly driven by Melbourne. So if you look at Australia down there, we've done very well, but we are now, you know, in fact, attracting international headlines as being subject to a second wave, with Melbourne going back into full-on lockdowns. And even in, you know, the poster child for treatment of the vaccine, New Zealand, which thought they'd eliminated it, it's now popped back up again in recent days, and Auckland has now gone back into full lockdown again with only 4 cases, or now 13 as it turns out. But again, bottom line here is, as I warned in earlier webinars, risks of second waves will be with us. And certainly that's been the story over the last few months, is that we got through the first wave, but the second wave has persisted, getting these second waves. Vaccine treatments, I mean, this has been something that's been driving markets on and off in recent months. Still very mixed reports about both drug treatments and vaccine treatments. I mean, Russia came out, I'm sure as you've seen yesterday, claiming it's got a vaccine. Hasn't gone through anywhere near the type of trials one needs to be satisfied that it's safe for, human use. But, Russia being Russia, they've gone ahead and made that announcement anyway. Things like remdesivir is a drug that, people, it is being used now for very severe cases, that with people that do need to go to hospital, do need to be put on ventilators. There is evidence of saying it marginally reduces the risk of people, dying once they're on a ventilator if they get that drug. So we are seeing drugs being used to reduce the death rate somewhat more amongst those the most severely affected. And in terms of vaccine, I mean, we're still up in the air. I mean, more and more experts are expressing confidence that we'll get a vaccine by early mid next year. But, we still have to wait and see. And so as a result, in terms of this year at least, we're still dealing with the virus. It still seems very unlikely we're going to a pharmaceutical solution to this problem this side of Christmas. I guess one variation since the last webinar, and I did mention the risks of second waves and renewed lockdowns. When we have seen that in Melbourne, we have seen that again in Auckland. So some governments are being very, very cautious in how they respond to the virus, and we're almost at the first signs of obviously Melbourne's a lot more serious, but going back into full lockdown. But some other areas, like some of the southern states, they did do face masks. They did, close down bars, engage in social distancing, but they didn't go into the full kind of lockdowns that we saw in parts of California and New York. And so I guess this is a new variant that maybe we, to some extent, are learning to live with the virus. Maybe the waves that should we get more waves in other countries over the next few months, to the extent they are localized, in sort of regional areas, and are seen as being contained, maybe we won't go back into lockdown. So that's an upside, risk for markets, is that, the risk of you can get second waves, they're a problem, but provided you don't go into full-on lockdown, then the economic consequences are potentially not as bad as they were a few months ago. And in fact, just this example shows, rate of new cases in US going at very high levels, but the death rate, even allowing for lags, is somewhat lower than we saw earlier this year. A, because the hospital system's being less overrun. B, because more of the people being affected this time around to younger cohorts. So, I mean, as we all know, the young aren't immune to getting a serious complications and dying, but certainly the death rate amongst people under, say, 60 years old and certainly under 30 is a lot lower than for older people. In terms of the economic, so what does all this mean in terms of the economic outlook? This is from the Google, again, it's probably the most timely indicator of activity in the economy. So this is what's called mobility. It's a measure of, people moving around. I mean, people worry about Google being able to know what we're up to all the time. Well, this is clear evidence of it. They know when we're moving, when we're driving in cars, just based on the GPS readings from the mobile devices. And this shows you, with the lockdowns earlier this year, a very big decline in mobility, right around the world, and we've had gradual recoveries ever since, and some more stronger than others. Obviously, Korea, Taiwan, and South. In fact, if there are, poster children for dealing with this virus, it's Taiwan and South Korea, which have been very good at containing and tracing outbreaks. And as you can see, in terms of mobility, they've, not suffered as much as some other countries. Sweden, to some extent, hasn't suffered as much. They've kept a more open policy. A little bit more debate there about whether, the extra deaths that they've got have been worth it. Not for me to go into that debate, but obviously just in terms of relative performance, Sweden's held up better than some other parts in terms of, at least on these mobility indicators. But the other point is that, most areas are on a gradual recovery path, and that's the other important point. Most with the worst, are we past the worst? I mean, I can, if the worst you mean in terms of rate of contraction in the economy, well, the answer is clearly yes. The worst was in April, and we're on a gradual recovery path. And as I said, we may well get second waves, but the risks of going back into full-on lockdown I think are diminished somewhat more now. A, with drug treatment, A, with better containment being in place. So I think in terms of the worst, we are past the worst. But the recovery, and we are in the recovery phase. The debate is how fast that recovery will be. Will it be, slow, a U-shaped recovery or a V-shaped recovery? And that's and obviously in terms of markets, that's where the debate, the big debate, is at the moment. Looking at some indicators for the world's most important economy, here's the United States, for example. And this is true around the world. What's been remarkable is retail sales, which initially nosedived, have bounced back in a very strong way. Just looking at the first slide there, retail sales in the US on the latest reading were back at the levels prior to the virus beginning. And and when you think about it, we've had so much income support to households, wage subsidies in many countries. So even if you've rather than your losing your job, businesses that have been negatively affected have been able to tap the government for wage subsidies to keep people employed. And even in the case of the US, those that do go on unemployment, they don't have a wage subsidy, have got extra unemployment benefits to sort of tide them over a little bit. So overall, and then things in Australia, for example, I'll touch on this a bit later, things like the drawdown of superannuation has really supported household income, at least in the initial instance, and it's allowed retail spending to bounce back. Now, there's obviously been compositional effects. Services like hotels, bars, restaurants are still down big time. Clothing is down big time. But things like consumer durables, motor vehicles, staples, things, to a lot of people working from home. So Woolworths has obviously been booming because people are buying more and eating at home relative to going to restaurants or buying something in a food court were they to be at work. And other consumer sentiment, look, I mean, although retail sales has bounced back, consumer sentiment is still very weak. Tentative signs of recovery. Housing starts, again, big decline, tentative signs of recovery. One to watch is durable goods orders. This is a measure of business investment. I'm a little bit concerned that over the next few months we will see a bigger collapse in durable goods orders as businesses curtail their investment spending, and that is a risk to the growth outlook, which could turn, does suggest more of a U-shaped recovery. But so far, at least, we haven't had the collapse in durable goods orders in the US as we saw in the last two recessions. But I think we may well see that emerge over the next few months. Other areas, initial jobless claims, again, in the US, this is a weekly measure. It's spiked to over 6 million. It's come down, but in the last few weeks, it's actually started to level off. And so the rate of improvement of the US labour market has started to slow somewhat. And you can also see that in the other issue, look at employment. You had a massive collapse in employment within 1 month. It has rebounded, but there's still a long way to go before the US gets anywhere near to the levels of employment that it had prior to the crisis. And similarly with the unemployment rate. China, again, if any country's enjoyed a V-shaped recovery, it's been China. And again, what they've done, they've been able to pump prime their investment, their infrastructure sectors. And so the rebound, as you can see, if you look at things like industrial production, real estate investment, infrastructure investment, that is now back at pre-virus levels. A very nice V-shaped rebound, thanks to credit easing, directives to local governments to, start spending money and build road networks, new property development, you name it. Retail spending has bounced back. It's still not quite back at the pre-COVID levels. And as we've seen, this is why iron ore prices, as I'll touch on later, have remained pretty strong. China still, despite it, having a debate with us about national security and whatnot, is still voraciously importing our iron ore, which is supporting iron ore prices in the resources sector. Australian performance, this is a measure of total hours worked, Australia vis-a-vis other countries. As I said, we're basically at the bottom, we've had a 10% decline in hours worked. Sort of middling performance, not the worst, not the best. Some countries have obviously had a bigger decline. So Australia is a sort of midway in terms of that rate of decline. And if you look at things like fiscal stimulus, I mean, obviously we've had a major, range of stimulus programs implemented over the last few months, and that just shows you on a global comparison basis how we fared. So it's big, but you know what? Some countries have provided even more stimulus as a percent of GDP, and I guess it's partly because their economies had a bigger, negative shock. So countries that have had more draconian social distancing restrictions, such as New Zealand and Canada, to some extent have provided more fiscal stimulus, but that's been the situation. As you can see, hours worked is now gradually coming back, but still well below the levels that we saw prior to the crisis. And this is that point I wanted. This is all the various, it's got this from the Reserve Bank, it's all the various policies to support household income in Australia as a share of annual disposable income. So we've had JobKeeper. So the JobKeeper, apparently there's 3.5 million workers in Australia that are benefiting from the JobKeeper program. So businesses that have claimed more than a 30% decline in revenues, and so they've become eligible for a wage subsidy to keep workers on the books. And we know from the surveys that 230,000 of those are actually on 0 hours. So at least 230,000 clearly would not be working were it not for the JobKeeper program. But 3.5 million Australians on the JobKeeper, 1.5 million are benefiting from the job seeker payments, so an extra $550 a fortnight for those on unemployment benefits. And early withdrawal of super, we've had 2.5 million people take $8,000 out, the first instalment, and then another 1 million of those, or 40%, take another, are likely to take another, or did actually take another 8,000 out in July, which is about a 30 billion withdrawal of super. So that's been a big boost. Now, some of that's been saved. If you look at measures of household saving in Australia, banks are flush with deposits because people have saved some of that money, parked it in deposit accounts, some of which are offset accounts, so they're effectively paying down some of their home loan. But no question, some of that money has been spent. So car sales have been very strong. Consumer durable goods have been strong. Flat screen TVs, the usual suspects, have been doing well. So households have been flush with cash, despite the loss of employment, and that's what's helped boost retail spending, at least in the short term. And you can see this here. This is a chart of retail sales in Australia in level terms. So that was been the underlying trend prior to the crisis. But if you look at total sales, you can see it's been very, very volatile. We had that big spike when everyone rushed out and bought toilet paper, the very initial instance of the crisis. Then we had a slump when the social distancing did kick in. We've rebounded since, such that the actual level of overall sales is actually higher than its underlying trend path before the crisis. So retail spending, would you believe, has been booming, but there's been a big compositional shift. As you can see, household goods well above average levels. As I said, consumer durables, Bunnings as well. People were spending time renovating their home. So those things have been booming, but things like cafes, restaurants, takeaway food have plummeted. They've rebounded somewhat as social distancing restrictions have eased, but still somewhat below the levels prior to the crisis. Labour market, probably the best single measure there is at the bottom chart there, total employment. As you can see, we had a big collapse in total employment. We've had a rebound since, but still a long way to go before we get back to where we were before the crisis. Unemployment rate has spiked up. We had another 100,000 jobs gained. This was reported in the labour market survey today. So we're slowly clawing back those jobs, but it's a long haul. And also total employment. There's probably many people, as I said, many people that are employed, but probably by grace of the JobKeeper program. So there is going to be an issue as that is scaled back after September. It will be scaled back a little bit, not by a lot, but as those do wane, we'd hope the economy would be strong enough that those workers can be retained, even as the JobKeeper program is scaled back somewhat. But also there's a lot of, so that's the situation with employment. What we do get from the ABS also is this fortnightly sort of update on the employment situation. It gives us a more timely measure. The labour market numbers come out on a monthly basis. This comes out on a fortnightly basis. As you can see there, we have been rebounding really since late April, but in the last few weeks at least, it has started to taper off. So that's a bit of a worry going forward, that maybe some of that employment rebound will start to taper off. Social distancing restrictions ease, so we get that bounce back, but then some of the secondary effects, downturn in housing construction, pullback in business investment, maybe start to cause employment losses in other areas that weren't directly affected by the lockdowns, but it's the more secondary effects. So that's something we need to keep watching. And again, it does add to the case that we're going to get more of a gradual recovery rather than, bounce back to normal very, very quickly. House prices, obviously a lot of interest in the situation there. I mean, house prices actually haven't fallen by as much as many feared at this stage. And as you can see, in the last quarter, they're down 1.6%. This is nationally, based on the core logic measures. Bigger falls in Sydney and Melbourne, where, I guess the virus has hit hardest, particularly in Sydney. But again, in Melbourne, you're looking over the past quarter, they're down 3%. And, it goes back to the point that at this stage, there's been a lot of income support for households. The other thing I haven't mentioned at this point, but now's the time, a lot of home loan deferrals. So banks are allowing people, that are having difficulty to defer home loans. And we know that something like 12% of all outstanding home loans are benefiting from a deferral of interest repayments at the moment. So again, that's an issue. It's part of this transition. I mean, eventually banks are going to want people to start paying their interest. And so at the moment, it's due to phase out over the next few months. And then it'll be after September, the banks are saying it'll be on a case-by-case basis. So again, it'll be part of this transition. How do we allow for a transition as the economy improves without overly upsetting, obviously, the housing market, but I guess from a bank point of view, just a social welfare point of view as well. I guess they're trying to be, good citizens at the moment and not push people out on the streets, but, end of the day, they're still running a business. So it's going to be a very delicate balancing act that will face 12%. It's only 12%, but that's still an outright number. A lot of people, and if many of them were forced to sell, it could have a further negative impact on house prices. But the bottom line at the moment is there's not a lot of forced selling. Forced selling is what causes house prices to collapse, and at the moment, not a lot of evidence of or need for forced selling. I mean, the other one that will obviously do that would be a big spike in interest rates, a big decline in affordability. But again, that's not very likely anytime soon as well. The RBA is going to keep rates very low levels for a very long time. The activity front, not so positive. So that's a chart of home building approvals on the first slide. So again, prior to the virus crisis, we're seeing tentative signs of recovery. Now they've started to collapse again, particularly high-rise apartment blocks, which were, booming prior to the crisis. Well, they did have a downturn, but they were showing signs of recovery. But now that has fallen away. So a lot of deferral of further high-rise construction projects. Off the plan sales at the moment is still very, very weak. It's probably an opportunity to snap a bargain potentially in some areas with some of those projects that have come on stream and not a lot of ready buyers. The other area, things like the ANZ job ads, is a very good timely indicator of the economy. And as you can see, that is still turning down. In fact, if you look at it on inverted axis, there's the jobless claims slumped. They've been a little bit of a tick up, but still a long way to go to get anywhere back to sort of normality. So that's consistent with very weak hiring intentions for a little while. What about business? This is talking about Australia, of course, here. So the business and consumer confidence, just a snapshot there. So we had a big plunge in business confidence and business conditions. Both have rebounded. Confidence has rebounded somewhat, but again, same story. Still well below the levels we've been to, and I think that will start to taper off over the next few months and still remain at well below average levels for some time. just given the uncertainty we're likely to continue to face with regard to the virus. Consumer confidence, same sort of situation. It has bounced back a little bit thanks to the income payments and the easing of social distancing restrictions. Since that chart was put together, where we've learned that it's pulled back a little bit in the latest reading that just came out yesterday, and again because of the Melbourne lockdown. So confidence is still overall business and consumer confidence still fairly subdued, though it has bounced back a little bit from the very low levels that it was at. These are some scenarios of GDP and employment from the RBA, and as you can see, even the debate here is how deep the downturn will be. The baseline, you're looking at basically, again, this is the worst over. In terms of contraction of activity, in terms of overall contraction in employment hours worked, yes, the worst is over. The debate is, well, arguably the worst is over. I think the base case is that the worst is over. Things could obviously get worse if we have, major flare up in cases and we need to go back into lockdown. But assuming social distancing restrictions are continuing to gradually ease around the world, we'll get recovery. So these are the recoveries. But even on the best case scenario, it's going to be some time before we get back to, pre-virus levels of activity. And even with the unemployment rate, the RBA's got it going up to 10% as a base case later this year, and then falling, but still remaining at relatively high levels over the next few years. So base case scenario is at this time next year, the unemployment rate would still be around about 8.5%. About the market outlook. So here are some key global market trends. Global equities, global bond yields. So that's the yield on the Bloomberg, what's called the Bloomberg Global Aggregate Bond Index. So it's an index of all global bonds in the world. So the average yield on those bonds, the US dollar and gold. First point, obviously equities have rebounded, but actually if you look at global equities from a long run perspective, really, yes, they've rebounded after a big collapse, and that they had a good 2019 after a dodgy 2018, but we've really been in this wishy-washy sideways range actually for a couple of years now, almost 2.5 years of sideways activity in the equity markets. It's been a very tricky period to negotiate. And look, the US S&P 500, I'm sure if you read the headlines, is almost back to its previous high. It's been flattered by the rebound in the tech sector, but elsewhere, markets are still somewhat below their previous peak levels, although we have had a very, sharp rebound after a very sharp decline. Bond yields have continued to trend lower, which has, helped support the rebound in equity markets. The US dollar recently has started to weaken again. Again, partly this is a sort of part of the risk-on sentiment as people take on risk. The US dollar is seen as a safe haven, so that's weakened with the rebound in global equities, which has also helped the Aussie dollar rebound. The other one has been gold in terms of commodities, really starting to strengthen, and that is really not because, well, some people may be buying gold because they think inflation is going to break out. But I actually think the biggest story is the fact that just global interest rates are so incredibly low. The opportunity cost of holding gold as an alternative safe haven has declined, and many people are now just holding gold in place of, say, global bond exposures, or as a complement to, given the very low yields you're getting on global bonds. So as global bonds stay low and potentially head even lower, I think gold will continue to be well supported, which I'll touch on a bit later when we talk about investment themes. Because they have been the trends. Why are markets rallying? Look, this is the three key issues. I mean, compared today with the GFC, and I touched on this in the previous webinar. Three key differences. Firstly, this is a kind of backwards recession in the sense that all the weakness has been front-loaded. We had 20 million jobs lost in the US within 1 month. And now we're gradually recovering. Typically in a recession, things gradually get weaker over 6 months to a year, even 2 years, and then they finally bottom out. Whereas this time, all the weakness has been front-loaded. So the rate of change of the data is now on the positive side. We're just debating how quickly it can come back. So that's why you had the big collapse in markets, and then now the rebound somewhat in the earnings. The other area is that the nature of the shock has particularly hurt, unfortunately, smaller companies and those that tend to have a lower exposure on the share market. So service-orientated, retailers, bars, restaurants, these sort of businesses, local tourism operators, rather than say some of the big companies like particularly technology. And so technology in the US is a very big share of the market now, around about 25%. And actually, not only has it been not as badly hurt by the virus crisis, some companies have actually clearly benefited because people have stayed at home, working from home, shopping more online. So the tech sector has been helped in a way. And compare that with the GFC, where one of the more important sectors back then was the financial sector, and that was particularly hurt by the lockdowns. And the other thing is an undeserved recession. So typically in recessions, they're caused by a breakout in inflation or excess debt. Central banks jack up interest rates to slow the economy, and therefore they're reticent to bring back the punch bowl very quickly. Whereas this time, given it was caused by social distancing, restrictions to deal with the virus, the stimulus has been a lot more proactive and a lot more forthcoming, and it's causing a bit of a melt up in valuations. And so just on that, if you look at the US global equity market, the outright PE ratio now looks high. So the blue line there, you can see the price to earnings ratio around about 20 times earnings. It's a level we haven't seen really since the dot-com bubble 20 odd years ago. But if you look at it relative to, and maybe I'll touch on this first, compared to 20 years ago, interest rates are a lot lower. So if you actually take that earnings yield, PE ratio, you invert it, you get the equity market's earnings yield, you take away the bond yield, you get what's called the risk premium, which is on the blue line. And as you can see, that is still comfortably above long run average levels. It's at the lower end of its range of the past decade, but it's still, above the levels we saw, going back 2, 3, 4 decades. And so the question at the moment is, and this is the TINA trade that people were debating before the virus crisis, interest rates are so low, relative to interest rates, the equity market arguably is not that badly valued. So maybe the market can trade at higher PE ratios given where interest rates are. And so this is that melt-up scenario that is helping support the markets at the moment. The other big one, as I showed, as I mentioned, tech sector very, very strong and resilient. That's the NASDAQ, actually clearly going through its previous highs. Why should we remain cautious? As I said, second wave risks have not gone away. Still no vaccine on the horizon. I think a U-shaped, once we get through this initial bounce, I think you'll see retail spending and business investment start to taper off. That big income boost will start to taper off from households. And earnings expectations are still quite overly bullish. And this is just a chart of the US situation. At the moment, the markets are expecting a 29% rebound in earnings next year, after a 24% decline this year for the US market, which is on a par with what we've seen in past recessions. But given the severity of the downturn, 8% GDP decline this year, I still think that's too optimistic. So I do see more earnings downgrades coming through, although the Q2 earnings reporting season, truth be told, in the US at this stage, it has been better than expected, only because earnings were slashed heading into the season. I think as we go into the Q3 and Q4 season, you're going to see more earnings downgrades. But look, I'm not super bearish. As I said, there are upside and downside risks here. Earnings are under downward pressure. Earnings are under downward pressure, but interest rates are likely to stay very low. So you could get a melt up in valuations or PE ratio staying high, if not going higher, is the offset. And in fact, and with those second waves, there is a risk that we try to avoid lockdowns in some countries and try to live with the virus to some extent. The other risk factor is the election year. Again, this is just a chart showing historically in the lead up to US presidential elections, the market tends to be very cautious. And I think there's a lot of grounds for concern if the election result is close. And for example, Donald Trump loses, but he then starts to contest the ballot, the validity of postal votes or whatever. So if this drags through the courts for a month or so, that could be a very negative period for markets. And the risk is that if Donald Trump does lose by a close result, he could drag it out. I think if Biden lost, they're less likely to want to drag it out, but we'll wait and see. But that is the risk. That's more of a risk than actually who ends up winning the election. I think markets will learn to live with whoever wins the election either way. Just in terms of investment themes, just to look, if you go through the sectors, I mean, these are performances by sector, by region, by factor. Look, the standouts at the moment are still global technology. I mean, it was the standout performer before the virus crisis, and as I mentioned, funnily enough, it's actually benefited from the virus crisis. So that is still doing very, very well. The US still doing very well. Emerging markets have started to do well with the weakness of the US dollar of late. I'm not too convinced that that will continue as a source of outperformance, because I do think the US dollar will start to strengthen again, even as we get through the crisis, because I think the technology sector, which is very dominant in the US, will continue to be strong. And so that will keep the US economy relatively strong and the US dollar relatively strong. And things like quality, companies with high return on equity, to looking at factors on the bottom part there, again, have been very, very resilient, as I argued they would be during this crisis, and I think will continue to do well. So technology and quality, in terms of factors and sectors, remain my two standout areas. And you can just see that there in terms of relative performance. The other one is a global gold miners, the top chart there. MNRS is global gold miners. Again, with the strength in gold, it's been doing very, very well in terms of performance, and I think that will, my hunch is that gold will continue to grind higher here, and that will support global gold miners as a theme, along with quality. Asia is Asian technology. Again, almost like an Asian version of the NASDAQ. You can buy that through an ETF, and that's also been doing very well. Australia, again, technology, our ATEC ETF has continued to do very well. Resources are doing well with the strength of iron ore prices. Most other parts of the market doing not so well. Smaller caps beating larger caps, and again, because the financials, really the banks at the moment are still dragging the chain in terms of our market. So smaller caps and the tech sector, resources, seems to be some of the standout themes, and you can see that there. Just, I think global bond yields are going to remain quite low. These are just some of the performances of fixed rate bonds. We've got a lot of different exposures, long duration corporate bonds through the credit ETF, and hybrids, HBRD. As you can see, they've continued to handily outperform, certainly with the rebound of late as credit spreads have come in. They've continued to outperform, and hybrids have really recouped a lot of their initial losses during the early part of the crisis. So hybrids and long duration bonds I still like, because I think credit spreads in Australia will remain relatively well contained, and bond yields are low and potentially fall a bit further. Look, I think that's pretty much the summary. I'll leave it at that and just open up to questions.
Hi, thanks, David. It was a really interesting lot to get through this month. We've had quite a few questions come in, and I'll just group a few because we've got some of the same ones. So thank you very much for that. So what is your projection for the S&P 500, your highs and lows for the next 12 months, please?
Yeah, good question. And before I do that, I was remiss. I just, again, in the interest of making the disclaimer very clear, this is obviously just a general investment, investment information. It's not personal advice. So I just want to make sure I make those disclaimers very clear. All our ETFs do have product disclosure statements available on our website. So I just do want to reiterate those various disclaimers. So just in terms of your question, look, it's a very good question. Look, I think the market can go a little bit higher from here. I think it will. The S&P can break through its previous highs, maybe get to 3,300, potentially even 3,400 over the next little while. And really, when you think about it, I think, I mean but I think that'll be probably as far as we can go. And there is a considerable downside risk given the earnings downgrades that we are going to get through. But look, I am conscious of the fact that even if you do get earnings, I mean, when you get earnings downgrades, it means the earnings are going to fall, and that's going to push up that PE ratio even more. And I think, even though interest rates are low, I think the market may start to get uncomfortable about how far it can really push that PE ratio in the short run. So if earnings fall and it pushes the PE ratio of the US up to say 20, from 23 to, let's say 27, Nasdaq's at 27 today. If it gets, above 25, I think that's where there'll be a limit to how far the market will be able to get pushed higher. So look, I don't have ready targets for you, but I mean, I think the market can push a little bit higher, but I think there is also a pretty good chance of a decent pullback over the next 3 to 6 months as well.
Okay, and another question asked by multiple people, previous attendees. Note, you have mentioned a W-shaped recovery previously. What's your thoughts on the likelihood of a W-shaped recovery now?
Look, again, we're all in the hands of the virus. So I guess my base case is continued gradual lifting of social distancing restrictions. So globally, and no, I guess, synchronized global-wide go back into lockdown. So if you go back to April and March, basically the whole world went into lockdown almost at the same time, or very close to it. So you had a synchronized collapse in economic activity. Now, if one country goes into lockdown but another country doesn't, the overall impact on activity is somewhat less. So if you get non-synchronized lockdowns, that's not too bad. But the other option is you get synchronized, partial lockdowns or gradual reimposition of social distancing restrictions. So under those various scenarios, anything other than a synchronized, back into full lockdown as we saw in March and April, I think the path is a gradual recovery. A W-shaped recovery is just that. It's basically going back into you get an initial recovery as economies open up, then unfortunately the virus flares back up again, and then countries decide that there's no choice but to go back into lockdown because we can't contain it. And then you go through the cycle. And hopefully by the time we go through that cycle, a vaccine will be ready by mid next year, and therefore we don't need to go back into that cycle again. And or by that stage, some degree of herd immunity has been built up so that even when we do ease the restrictions next time around, we don't get a flare-up because of the levels of herd immunity. And some have actually arguing that, it used to be said that you need 60% of the population to be infected or to have had the virus and become immune to get herd immunity. Whereas now some are suggesting with using face masks, with social distancing, like maintaining certain distances within restaurants and whatnot, potentially herd immunity could be as low as 20%. So that's something to think about. It goes back to that point that maybe we can learn to live with the virus and ease social distancing restrictions and deal with more isolated breakouts. But that's the W-shaped scenario. I'm less of that because the new information is that maybe we can learn to live with the virus and not necessarily go back into lockdown again. I know there's some out there who, as soon as there's one person gets it, people want to, some of the, I won't, name names, but there's some people in the media, Norman Swan, for example, he basically wants to have the whole country go back into the Stone Age until such time as, a vaccine is available. It's just completely untenable. And it seems to be this like hairy-chested approach where, let's be really tough and have complete lockdown until we've eliminated the virus. I mean, as New Zealand has shown, you can't eliminate the virus. It's very hard, and you've probably just got to learn to live with it to some extent.
A question here by multiple people. David, what is your view on the long-term impact of both the government wage subsidies and this early withdrawal of super?
Well, the early withdrawal of super, I mean, so some, mainly it appears to be, younger people who've tapped into their super. I mean, I guess their view is they've got, a long time before they need to retire so they can rebuild those savings. So, for those people affected, their super is going to be less than it would otherwise be. And so, that's from my own, again, I can't talk for people's circumstances. So, you know, to some people, it's probably been a reasonable thing to tap onto their super, but it obviously will have a long run cost to many people that have tapped into it. Look, at the end of the day, 30 billion is a lot of money, but as a share of the overall superannuation system, it's still pretty small. So it hasn't really, you know, had any market impact in terms of, you know, collapse in equity prices because superannuation funds have needed to raise cash. I mean, some industry super funds had some, you know, initial difficulty worrying about having to pay out those withdrawals because a lot of them are invested in fairly illiquid type assets, but they seem to have managed it, you know, reasonably well. So, you know, it's not ideal, but, you know, for those that have, I can't really criticize people so much, you know, if they want to tap their super and do, you know, because they've lost their job, or, you know, they see it as an opportunity to buy a car, you know, buy a car and enjoy a car, and you'll have a lower retirement in the future, but, you know, that's your decision. In terms of the withdrawal of the JobKeeper, look, end of the day, it's a bit like the reserve. People often ask, you know, what happens when bond yields go up? What happens when the central bank raises interest rates? What's that going to do to the economy? Well, you know what, as long as inflation is not a problem, central banks won't raise interest rates in a way that will derail the economy. And if there were signs of that happening, they would stop doing it. As we saw with the Federal Reserve in 2019, 2018, when they were raising rates in 2018, people said, oh, they're going to cause a recession. But you know what? They stopped doing it. When the risk of a recession seemed to become a material, they stopped doing it. So similarly with the job subsidy scheme, the government, look, does want to wean the economy off it. As we recover, you obviously want people to be encouraged to go back and get a job. You want businesses to be encouraged to, like, you know, stand on their own 2 feet. So we do need to wean people off it. But I think, you know, and again, it's going to be delicate to manage. But if the withdrawal was such that it did cause an untoward weakening in the economy, I think the government would slow that pace again. So, you know, I'm not concerned that a hasty withdrawal of this will risk a slump in the economy, because the government will adjust in the same way that central banks adjust the pace of withdrawal of the payment. And, you know, they will withdraw it as the economy, you know, the hope is that the economy will be gradually getting better, and so that they can withdraw it, and then businesses will be able to, you know, keep workers on, or if they can't, there'll be other jobs available.
Just some thoughts on gold, David. So is the relationship between the US dollar and gold still intact? And any thoughts on a projection in the next 6 to 12 months?
Yeah, look, in the short run, gold has gone up. It's got a leg up, let's say. It's got a leg up because of the weakness of the US dollar. And the weakness of the US dollar is actually kind of a risk on. It's funny because gold is seen as a safe haven, but it's actually been rallying, even with equities rallying, because the US dollar has been weakening. But if you actually go back over the number of years, it's the strongest correlation between gold is not with the US dollar, or with inflation. I mean, inflation's been dead and going nowhere for years. It's with real interest rates, or short-term interest rates allowing for inflation, but even nominal interest rates, because inflation, you know, the interest component's not been that, the inflation component hasn't been that volatile. So interest rates have been gradually trending lower for the last few years. I mean, basically when the Fed stopped raising rates, bond yields started to decline, and gold started to rise from mid-2018. And now with the COVID crisis and yields going even lower, it's given gold a leg up even further. So it's interest rates, it's bond yields that are the major driver of gold rather than the US dollar. So as a result, it is possible that gold will continue to rise even if the US dollar starts to strengthen again. And again, because of, you know, the dominance of the tech sector globally, and the US role within that. And so gold, and the biggest risk to gold is when and if bond yields start to back up. But central banks are promising to keep interest rates very low until such time as inflation picks up. And I don't see inflation picking up, so I think interest rates are going to stay low. So as a result, that's going to support gold. So a projection, look, I don't like to give numbers. I mean, But you know, I still think the direction is up. But you know, giving a number, it's just, you know, finger in the air type stuff. To be honest, I just think the trend is still up as long as bond yields stay low, and potentially go even lower if the Fed does more stimulus, for example. I mean, just on that, one thing to watch is the Fed goes, say if the US growth starts to taper off, for example, and the Fed does yield curve management where it says it's targeting a certain bond yield, or it even goes to negative federal funds rate, you can't rule that out, then, you know, gold will definitely go higher in that sort of environment.
And just some questions, and I know that you've said before numerous times that the market likes certainty. A few what if Donald Trump wins the election and what if Joe Biden wins the election questions across the board.
Well, yeah, again, I think both pose risks to markets, you know, positives and negatives. But in terms of the risks, obviously if Donald Trump wins, you know, people are worried about, you know, his continued erratic behaviour. But, you know, markets have got comfortable with that. I guess the biggest risk for Donald Trump, whether he restokes the US-China trade tensions, I think it'll be very interesting if he wins, whether he does do that or not, because basically and that'll be a test of whether or not all this stuff about US-China tensions was really just a political smokescreen to like appeal to his base, or whether it was a legitimate policy concern that he wanted to pursue. Because should he win, he doesn't need to appeal to his political base anymore. He's never going to be subject to an election campaign again. And so it'll just be interesting whether or not he does restoke those tensions as much as the markets fear. And it could well be that he basically, you know, doesn't bother. So we'll see on that. But that's the risk on that front. With Joe Biden, I mean, the risk is, I mean, there's two risks. A, you know, greater regulation of the tech sector, potentially even a breakup, you know, antitrust arguments in terms of Amazon and whatnot. Still think there's a lot of water to flow under the bridge before anyone would contemplate that, although it's a very legitimate policy concern, if you ask me. I think it's quite a legitimate issue. But even if they did break up, I mean, the tech sector, if you look at things like energy, big oil, telecommunications, when they were broken up in the US, depending on how it's done, existing shareholders in those companies may not fare too badly. So, for example, if Facebook is forced to divest a certain company, say Instagram or something, the existing shareholders may own shares in Instagram, and Instagram on its own may well do very well. So it's not clear as a shareholder you actually lose out, even if you do ultimately get breakup. The other issue is, you know, greater privacy restrictions. And again, my argument there is ultimately, you know, companies, Facebook, Google may not be able to micro-target as much as they do in terms of their advertising, should privacy restrictions be put in place. But it's still probably the best advertising tool around, and they'll, you know, their business models will be retained. And look at the situation in Europe. People are still using Facebook and Google, even with the greater privacy provisions available at the moment. The other one is a corporate tax increase. And this is, I guess, a more serious issue for them. Well, it's another issue. And the big risk, you know, if Democrats win, and certainly if they win the Congress and the Senate at the same time, then talk of corporate tax increases next year could come on the table. And what does that mean for markets? It won't cause a bear market, but it's probably worth a, you know, 10% correction in the markets due to that uncertainty, and a reimposition of a potential corporate tax increase. So there are the factors. But as I said, the bigger issue, well, before anyone, ultimately, I think markets learn to live with whoever is US president. US presidents in and of themselves don't cause bear markets. But the bigger issue the issue before the election is just if it's drawn out for a long time in a period in which the economy remains weak and may be in need of more stimulus. And if you think back to 2008, the last leg of the GFC bear market was in that period between the election campaign and when President Obama was sworn in. That period of you know, political you know, incapacity to do any policies out of Washington.
Mm-hmm. Look, I am aware that we've gone significantly over time. There's so many questions. I think we could just do a 45-minute webinar just on questions, David, but we will leave it there today, and we will come back to any questions that we haven't replied to. The team will be in touch and we'll be able to answer those questions. We thank you very much for your time today. We hope you found the session interesting and useful. A recording of the session and the slides will be sent to you later this afternoon, and I'm sure David will be able to follow up some of those questions in his weekly insights articles. So please look out for that. There's definitely some things and lots to talk about at the moment. So thank you very much for joining us. Thank you, David.
Thanks, everybody. See you next time.